When you own shares in a company, there are several ways that the value of your shares can go up. The typical way that most people think about, especially in the recent past, over this last decade, as we've really seen high growth companies take off, disruptors take off, and the values increase there, the typical way that you think of is the company investing the money that they have into further projects, into more growth, more innovation, more technology, something to put them ahead of the curve so that in the future they can generate even more revenue and ultimate profits for you, the shareholder. And a lot of times as a shareholder, if it's the right company with the right management team at the helm, that's what you want. Google comes to mind. I did a video a couple weeks ago on Google where they effectively have their own sort of venture capital firm within their company, and they have a good track record of being able to take their internal ideas and turn them into money-making machines in the future. So I want them to invest extra cash flow that they have into those projects so that it'll benefit me as a shareholder in the future. But that's not the only way that a company can reward its shareholders. You see, when a company has earnings, they can choose to reinvest it into those projects, or they can choose to give it back directly to the shareholders. There's a couple ways they can do that. They can write you a check in the form of a dividend, or they can buy back their own shares, reducing the number of shares outstanding so that the shares that I own are now worth more. They represent more of the earnings that the company is bringing in. I recently put together a video where Warren Buffett explains exactly why and when companies should be buying back their own shares, when it makes sense and when it doesn't. But in these trying times where the high-tech, high-growth stocks that have performed really well over the last decade or so are now really struggling, I wanted to look for the companies that are giving back the most in those other ways. Specifically, I wanted to look at those companies that have been repurchasing more of their own shares than any other company. In fact, over this recent cycle, the market in general has set a record for the value of shares that have been repurchased. So companies in general are buying back more of their shares, but which ones are buying back the most? And then also which ones are in the best position to be able to buy back more in the future, to be able to continue that trend, bringing value to you as a shareholder. I've put together that list and I'm excited to break it down for you coming up. Welcome back, my favorite 17,000 people. Happy Memorial Day. I took a break from the festivities to put together this video for you. I hope you appreciate that. Definitely let me know with the like button so that it can spread to more people if you do. I hope you've had a good weekend. I'm feeling pretty good, although I did break my toe again in the finals of our competitive soccer team. I think I'm getting too old for this, but anyway, it's fun. Keeps me in shape, so I should probably keep doing it until I really, really mess something up. Anyway, you don't care about that, you care about these stocks. I put this together because I thought it would be either a great supplement to additional research that you're already doing, or just give you some screening ideas so that if you see something that stands out to you, you can then take that information and run with it to start your own in-depth research. So what I looked at here was how much a company was able to reduce their total shares outstanding over the last 2 annual reporting periods, and then to determine which ones were in the best position to be able to do that again in the future, now that they've proven they're capable, interested, willing, all of that. I looked at free cash flow yield. So the amount of money that's left over after they take care of all their obligations, after they do all of those things, how much still flowed into their bank account, even after they made all those purchases, after they did everything else with their business, which companies had the most money left over so that if they wanted to buy back more shares next year, they still could. Right, so that's what my free cash flow is showing me. Now the free cash flow yield is how much free cash flow they have relative to the cost of the stock. So either free cash flow divided by total market capitalization, or free cash flow per share divided by the individual share price. So that's what I looked at here. As we fill out this chart, you're going to see their free cash flow per share. That's the trailing 12-month figure, the most recent figure I could find for you. You're going to see the share price, and that's pulling from Google Finance. So that's absolutely up to date as of the minute that I'm recording. And then you are also going to see the last 2 years worth of shares outstanding. And so when I'm looking at share reduction, I'm looking at the difference between those 2 years. And then also I pulled over their dividend. I want to know what their dividend yield is as well, because like I said, those were the 2 ways that they can give money back to you, to me, the shareholders. So these were the top 12 companies in the entire S&P 500 at reducing their number of shares outstanding over this last year, who were also in the top third of a company's free cash flow yield. So if they weren't in the top third of free cash flow yield of all S&P 500 companies, then we took them out entirely. So these are the top 12 that were left over as far as share reduction over this last year. So let me show you what I put together on my screen right now. One of the things you'll notice and that I found interesting about this group of stocks is that they're not all from one industry. There's relative diversification here. It's not like a single industry just did really, really well over this last year, and so that's why they were all flush with cash and able to repurchase all their shares. That's not what was happening here. So you can look and find the industries that you like the most, that you understand the most, or the ones that would fit best in your portfolio, and start your research from there if you'd like, but you have options here. All right, so let's start with this first stock here, Bath & Body Works Incorporated, BBWI. Any value investor is going to be familiar with this company as a stock. It's been kind of on value screeners for a really long time, which is not a good thing. That means it kind of has a perpetual low valuation. But one thing that they were able to do over this last year is, of these 12 stocks, it's the lowest here. I have this in order of the least reduction to the greatest reduction, but they're one of the top stocks in all of the S&P 500 at reducing the number of shares outstanding. So you can see their shares went from 278 million down to 254 million. And we can see that here. We just pulled up SeekingAlpha, and I'll walk you through their financials. If you scroll down to the bottom of their balance sheet, you can see their total common shares outstanding, and you can see over the last 2 years where it went from 278 down to 254. Now you can also use this information to look back and see if they have a trend of doing this. Bed Bath & Beyond doesn't, whereas a company like eBay has been significantly over the last 5-6 years reducing their share count continuously. I'm not saying that means they're a good stock to buy, but it is something that's working in your favor. So it's definitely worth considering and keep in mind as you're doing this. You can also see, compared to their last quarterly report, that they have still been making reductions from the count that I looked at. So something to keep in mind. I'm just going to go into this level of detail with this first one so you can know where the numbers are being pulled from. That's where I got these numbers. The share price is being pulled straight from Google Finance. And then the free cash flow per share is back over here. You can hop over to the cash flow statement, drop down to the bottom, free cash flow per share. I looked at the trailing 12-month number, so that should be the most recent information that we have from the most recent quarterly report. And then you can also come over here on the summary to see what their dividend rate currently is. So with that information, that builds out our data over here on the right side, and that's going to populate how much share reduction we had. So they were able to reduce their share count by 8.63%. Their free cash flow yield is still 10.69%, right? So that's the cash flow per share divided by the share price. So they still have that much cash to work with, which is great. That's a good sign going forward. And then they're still paying out a dividend. So even if you don't think that Bath & Body Works, and if I said Bed Bath & Beyond, I feel like I did. I'll see when I'm editing. If I said that in the past, I'm sorry. Too many baths. I get them mixed up. But even if you don't think that Bath & Body Works is particularly innovative, is going to be able to invest and grow their stock, has that sort of growth trajectory, they don't. I don't think anybody really thinks that. But even if you don't think that, there are still other ways that they can release value to their shareholders. So it's worth keeping in mind. Now, I need to say with all of this, I am a practicing professional, and this is not investment advice. I'm not recommending that you do anything with these companies. I'm definitely not recommending that you invest in them. I don't currently have a position in any of these. You would need to either do your own due diligence or have a one-on-one conversation with a professional who could advise you in that way. I can't do that in this video, so that is not what I'm doing here. But I do hope that the information that I'm putting together here and in other videos helps you to do that research so that you can be more confident in your overarching investment strategy in your portfolio. That's my goal here, nothing else. I hope that helps. All right, let's keep going. So we'll go a little bit faster now that you understand the information that's going into this chart. So the next one is ticker SYF. It's Synchrony Financial in the financial industry. They have reduced their shares by 9.79% over this last year. They have a free cash flow yield of 33.48%. Now, financial companies can be a little weird, so definitely look into that. Don't just say, hey, this has the highest free cash flow yield of all of these companies, which it does. And so, that's necessarily a good sign. You should look into the details, make sure you understand what's going on behind the scenes. They also have a relatively high dividend yield compared to the other companies on this list. It's currently at 2.43%. Now, the next company on the list is Capital One Financial Corp, ticker COF, also in the finance industry. So the same disclaimers apply here with their 17.59% free cash flow yield. but they were able to reduce their shares by 9.38%, so almost 10%, which is significant. Think about this. If there's only 10 shares outstanding, there's 10 pieces of this pie, and you own one of them, you own 10% of that company. So you have the rights effectively to 10% of their future earnings, or any dividend that they put out in the future. You're going to have the right to 10% of that. You own 10% of this company. Now, if they buy up 10% of those shares, so they take away one of those shares, now there's only 9 shares. Well, 1 divided by 9 means you own a little bit more than 11% of the company now. And when we get to the highest share reductions here, later on this list, we're talking closer to a 15% reduction, which means if you took 1 divided by 8.5 shares, if they were able to reduce the number of shares by 15%, that's closer to a 12% ownership. So your ownership just from these share repurchases is increasing by anywhere from 10 to almost 20% without you having to do anything, without the company really having to do anything except buy up their shares in the open market. And with the markets falling, this can be a good time for them to do that. Here's another thing to think about. These companies aren't trying to buy a certain number of shares usually. Now, when Warren Buffett explains when companies should be buying their shares, they probably should be paying attention to the share price and only buying it when they think it's undervalued and not just indiscriminately buying it. But that's not how most companies do it. That's how you should think about it. That's how Warren Buffett thinks about it with Berkshire Hathaway. At least that's what he says. Most companies, on the other hand, are authorizing share buybacks. They're authorizing a specific amount of money, and they're gonna buy back shares as a way of bringing value back to shareholders. Let's say, for example, a company authorized $1 million share buyback. That'd be really small, but that'll help me with the numbers here. If the share is worth $100, if it's $100 per share, that means they could buy 10,000 shares, right? They could reduce the share count by 10,000. So the shares that I now own are effectively entitled to a greater percentage of the company, even though I still own the same number of shares, which means my share price should go up because the company as a whole is still worth the same amount, but there's fewer shares outstanding, right? That's good. That's how this whole share repurchase program plan is working to my benefit. But what happens if the share price jumps up? Now it's $200 per share. Well, they still authorized a $1 million share repurchase. So if they execute that $1 million and they buy back the shares at $200 a share, they're only going to be able to buy up 5,000 shares, right? Half as many. So I still benefit from that, but not by as much. See, the dollar amount is less meaningful than the share price at which they're buying it up, the number of shares that they're able to buy up. So when the share price is higher, they can't buy as many shares, which is less of a benefit on a per share basis to me, which is what I care about, the per share basis, right? Now, if the share price dropped from $100 down to $50, now that $1 million is able to buy 20,000 shares. So it's even more beneficial to me. So as the market in general is coming down, putting pressure on all stocks indiscriminately, and their values are coming down, these companies that have high free cash flow and have a propensity for buying their own shares could be in a good position to really unlock some shareholder value for you, should you be a shareholder at the time that they're doing that. So just something to keep in mind during all this chaos when you're trying to figure out the best place to put your money. All right, let's continue. I hope that makes sense and you can see a little bit more of why this exercise could be valuable. So next stock here is Nucor Corporation, ticker NUE. And they're in the non-energy materials. They were able to reduce their shares by just under 10% over this last year. Their free cash flow yield is over 16%, and their dividend is 1.45%. Next one is ticker HCA. It's HCA Healthcare. They're in the healthcare industry. They were able to reduce their shares by almost exactly 10%, and they still have a free cash flow yield of 6.69%. So they're one of the lowest, I think the third lowest on this list from a free cash flow yield. But again, remember, this is a pretty selective list in that it's still in the top third, the top 33% of all the S&P 500 companies. So it's still pretty solid, but worth keeping in mind and looking into. And their dividend yield is just under 1%. The next stock is Quest Diagnostics Incorporated. It's ticker DGX. And they're in the healthcare industry as well. They were able to reduce their shares by a little bit more than 10%. They have a 9% free cash flow yield and a 1.82% dividend yield. Next, we have a telecommunications company. It's Charter Communications Inc. That's ticker CHTR. They were able to reduce their shares by just under 11%. They have a 9.3% free cash flow yield, and they don't pay a dividend. So they're one of two companies on this list that doesn't also pay a dividend, that doesn't also provide that level of shareholder value to their shareholders. All right, now we're in the top 5 of share repurchasers who have solid free cash flow yield. So the 5th best over this last year that met all those criteria is Marathon Petroleum Corporation, ticker MPC. They're in the energy sector, obviously boosted by the macroeconomic conditions that are affecting oil. So we don't know exactly how long that'll play out. And I believe when I was looking at their shares in the past, they've increased shares and decreased shares pretty frequently. So they've gone both directions. So keep that in mind. Again, you want to look at their track record if that's really what you're banking on. But they did make the cut. They were able to reduce their shares by more than 11% over this last year, which is significant. They have a free cash flow yield of 7.6%, and they do pay a dividend of 2.27%. All right, number 4 is ticker DVA, DaVita. They're in the healthcare sector as well, and they were able to reduce their shares by just about 11.5% over this last year. They have a healthy free cash flow yield of just under 15%, and they're the other company that doesn't pay a dividend today. Number 3 is Best Buy, ticker BBY. They're in the consumer cyclicals industry, and they were able to reduce their share count by 11.5% over this last year. Now, they recently, on their most recent earnings report, had a very sharp reduction in their free cash flow. They did have a very healthy free cash flow, but it kind of changed overnight. They were more than 10%, now they're below 5%. They're the worst one on this list. So if that inflation squeeze continues to happen, and consumers continue to feel that, and so they're spending less at places like Best Buy, then I think their free cash flow is going to suffer, and they're going to have to reduce the number of shares that they're buying back. I think their hands are going to be tied there, even if management really wants to do that. So again, something to keep in mind as you're doing your research here. But Best Buy does seem to, at least for me, continually surprise with how long they've been able to hold out in this digital age. People are still going to Best Buy, still buying things from Best Buy, even though they have these bigger competitors like Amazon trying to push them around. They do offer a very compelling dividend, higher than 4%, which is in the top 25% of dividend payers in the S&P 500. It's definitely the top on this list. So a few things to keep in mind as you're doing research there. A lot of compelling reasons to look into it further, but also maybe a couple to give you some pause and allow you to proceed with caution. All right, number 2 is eBay, ticker eBay, EBAY. They're in the consumer non-cyclical industry. And they were able to reduce their share count by 13.16% over this last year. If you look at their trailing 12 months, they're still reducing their share count. If you look back over 5 or 6 years, they have been consistently reducing their share count. So again, that's not me saying this is obviously a buy. It's me saying this from this isolated input. It's a compelling reason to look further into the stock. Obviously, they're going to have other things going on. There might be some massive red flags and reasons not to invest, or reasons that you particularly wouldn't like investing. But from this perspective, they have a very strong track record of reducing the shares outstanding, which brings value to individual shareholders. Now, they do have a restricted free cash flow yield, at least relative to the other companies on this list, at just under 6%. They do have a dividend, though, at 1.8%. All right, the number 1 company as far as share buybacks over this last year was HP Inc., ticker HPQ. Now, they're in the technology industry, and they were able to buy back 16.24% of all their shares outstanding, which is incredible. They have a very healthy free cash flow yield at north of 14%, and they also are paying a dividend at 2.6% roughly. So I hope this has given you some ideas. This was a quicker video. Let me know what you think about it, and let me know in the comments which of these stocks, if any, you'd like to dive in deeper. If there's enough support, then maybe I'll spend a whole video and we'll do a deep dive, or at least look a little bit further into one or more of these companies. If you'd like to learn to deep dive into companies, you should check out this playlist of deep dives if you haven't already. I look forward to seeing you there and in the comments, getting to know you better. I wish you all the best. Take care.